did you?
Another sign the Bitcoin bubble is ending? China launches an unprecedented crackdown on cryptocurrencies. Those that sold their cryptocurrencies at the peak of the market made a tremendous amount of money, but those that hold on to the bitter end are going to be gravely disappointed. For a while there, it seems like cryptocurrency prices were going to go up forever. 2017 was the best year for cryptocurrencies ever, and lots of investors were becoming millionaires on paper. But now the Bitcoin bubble has burst, and the losses are absolutely staggering. Unfortunately for crypto investors, it looks like things are about to go from bad to worse, because China has just launched an absolutely unprecedented crackdown on cryptocurrencies. Potential government intervention was always the elephant in the room for cryptocurrency enthusiasts, and now it is becoming a reality in a major way. How would you feel if the value of your investments fell by 75% in just 7 months? Well, that is precisely what has happened to cryptocurrency investors. The following comes from the New York Times. After the latest round of big price drops, many cryptocurrencies have given back all of the enormous gains they experienced last winter. The value of all outstanding digital tokens has fallen by about $600 billion, or 75%. Since the peak in January, according to data from the website coinmarketcap.com. Sadly, this could potentially be just the beginning of big trouble for the cryptocurrency industry. China has not completely banned cryptos yet, but they appear to be moving in that direction. As Robert Wenzel recently noted, the crypto crackdown in China is becoming very intense. Financial officials in an eastern district of Beijing issued a notice last week to stores, hotels and offices urging them not to host any cryptocurrency-related speeches, events or activities. The document also asked that any activity be reported to local officials and said authorities were acting on behalf of a working group led by the central bank to clean up cryptocurrency trading, reports the Wall Street Journal. In a commentary published in state media on Friday, according to the journal, Shangsong Cheng, an advisor to the People's Bank of China, said that after fundraisings called initial coin offerings were banned last year, government regulation will become even more restrictive. He wrote that earlier this week, authorities blocked a number of public accounts involving ECOs on the popular messaging app Weiqi. In addition, we have just learned that China has decided to permanently block over 120 offshore cryptocurrency exchanges. More than 120 offshore cryptocurrency exchanges have been blocked by Chinese authorities, the South China Morning Post reports. The exact reasoning is not entirely clear. The central bank didn't respond to calls from SCMP reporters, though some speculate that the crackdown is a response to increasing financial risk and instability. The government will continue to monitor for any new crypto news sites and announcements of initial coin offerings, ECOs. If any appear, the government will shut them down immediately and deny user access by blocking their IP addresses. That is an absolutely devastating blow to the cryptocurrency industry. On top of everything else, Chinese tech giants have decided to ban crypto-related transactions. In a move that will likely make it even harder for cryptocurrency aficionados to trade Bitcoin on its ilk in China, the mobile payments titans of the country have barred crypto-related transactions. Weiqi Pay and Ant Financial's Alipay are monitoring their platforms for transactions related to cryptocurrencies, with Weiqi saying Friday that it would prohibit users from sending funds related to such digital assets on its social media platform. It's a notable move. Chinese citizens have rapidly adopted the technology. Over $12 trillion changed hands via mobile in the first 10 months of 2017 alone in the Middle Kingdom. A coordinated effort to kill the cryptocurrency industry in the second largest economy on the planet appears to be well underway, and this is going to have very serious implications for cryptocurrency prices. Meanwhile, the cryptocurrency industry just suffered another blow at the hand of U.S. regulators. The U.S. Securities and Exchange Commission has rejected another round of attempts to list exchange-traded funds backed by Bitcoin, blocking it from per-shares, granting shares and direction on concerned prices could be vulnerable to manipulation. In a trio of orders posted on the agency's website Wednesday, The Commission said proposals to allow the funds fail to show how exchanges seeking to list the products would prevent fraudulent and manipulative acts and practices. For a long time I have warned that the ultimate fate of the cryptocurrency industry was going to be determined by what national governments decided to do. They seemed to have a hands-off policy for quite a while, and the cryptocurrency industry thrived. But now a global crackdown has begun, and it could ultimately mean the death of the entire sector.
Don't expect new Bitcoin highs in 2018 despite an already 6-month cool-off period. For 2018 we see more sideways and downside potential in the Bitcoin price due to sluggish retail demand, hesitation from institutions and a current market cap that seems too high relative to the activity occurring on available blockchains. Many investors and advisors are on record stating that $5,700 was the bottom in Bitcoin for this year, and that higher prices lie ahead. While we are very bullish on Bitcoin's long-term prospects, we do heed caution for more short-term price optimism. To find the starting point of the historic parabolic rally in Bitcoin that ended at $20,000 we have to go as far back as August 2015, when Bitcoin traded at below $200. This past rally was a stupendous, historic move. Even in secular bull markets, the collective of economic actors need time to absorb the information embedded in its characteristic high-volume rallies. As I've indicated in my 2018 outlook, I think chances are high for this year to be remembered as a shakeout year, a lemon market in altcoins, regulators catching up and infrastructure growing pains. Short-term bearish signs since January, the Bitcoin mining hash rate, aggregate computations per second made to secure the network, has tripled, which means that a huge amount of newer more efficient mining rigs have come online. In combination with declining prices, this means that miners who weren't able to upgrade their machines or find cheaper electricity have been faced with a steep decline in profitability, a 90% drop in 7 months. Altcoins have faced similar or steeper declines. With profit margins under heavy pressure, it's not unlikely that miners are and will stay responsible for a significant amount of selling in the market. Next, trading volumes are not dead, but still below those seen during last winter and spring. It's unclear how much of the recent pickup in volumes are the result of a short squeeze and how much is coming from new long-term buyers coming in. After last year's FOMO, retail interest in Bitcoin has now become very sluggish. A Gallup poll conducted 3 months ago suggested that less than 0.5% of U.S. investors will probably buy Bitcoin in the near future. Despite transaction fees and volatility having dropped strongly, merchants are seeing plus 50% lower Bitcoin revenues compared to last fall. Google searches are not suggestive of a quick retail-fueled recovery either. Next, here are some comments we've gathered from Bitcoin analysts, market makers and Wall Street insiders. The first Bitcoin ETF will likely not be approved before 2019. So any anticipation of approval by September will likely be met with disappointment. While institutional investors are certainly getting involved in Bitcoin, the vast majority of the firms are trading firms who are looking to make markets regardless of price. They're just as happy to take on short positions as they are to go long. Institutions who are known to be long biased, such as mutual funds and pension funds, are not ready to invest because they're not yet comfortable with the available custody solutions. There's also the NVM ratio, which is designed to reflect early-stage adoption, now suggesting that there's now too little on-chain activity to justify Bitcoin's current market cap. The assumption here is that Bitcoin's market value is mostly derived from it being a network that connects users around the world. The more people and entities use the Bitcoin blockchain to settle transactions, the more it acquires the liquidity and utility that we'd expect from digital gold. The NVM ratio approximates that by measuring daily active addresses on the blockchain. Similar valuation models have been made for growth companies such as Facebook and LinkedIn, where the number of monthly active users reasonably correlates with enterprise value. There are several objections one could raise against the NVM ratio. It doesn't take into account transaction amounts nor the difference between old and new addresses. It doesn't discount spam attacks. It doesn't acknowledge limitations to the block size, and neither does it consider institutions coming into the market who build derivatives on Bitcoin that rely on a small amount of high-value cold storage addresses. More work is needed to refine valuation models. That said, even though Bitcoin's core value proposition is as a store of value, we do think we're still in the early adoption phase, and hence using a valuation metric that reflects this adoption makes sense to us. In that context, we think the NVM's on-chain activity-based valuation method has merit. The related NVT ratio, which tries to measure if the daily dollar value of all Bitcoin transactions is relatively high or low versus the market cap, also suggests overvaluation. Finally, in the past few months, we've also seen a number of macro events that would appear to be bullish for Bitcoin as a safe haven: the North Korea debacle, a spike in volatility, Chinese stocks breaking down, etc. However, these shocks didn't move the meter for Bitcoin. Some caveats: all this being said, lower Bitcoin prices ahead are not a foregone conclusion. The Bitcoin price has already come down by 62% since December. Since March, the Chinese yuan has dropped by 8% against the dollar. If this slide continues, Chinese capital could flee into Bitcoin. Bitcoin dominance is gaining ground, which we think indicates the market's slow realization that there's a large moat around the Bitcoin ecosystem now, which will make it hard to dislodge. The 2015-17 rally was historic but not entirely unique for this ecosystem. Between late 2011 and April 2013, the Bitcoin price multiplied by 100x, and, after a 6-month correction, it multiplied again by 10x. Value investors are already anticipating the May 2020 block reward halving, which will cut down Bitcoin's annual supply inflation from 3.7% to only 1.79%. A Bitcoin ETF approval, even if it's delayed, would be a huge deal because it makes the asset extremely accessible for the retail investor. After the first gold ETF went live in 2004, the gold price rallied by 350%, and it's still 200% higher today. The 2017 rally has also set in motion a flurry of corporate activity on the Bitcoin infrastructure side, and the promise of established banks, brokers, payment processors, and security providers offering their own solution suites is catching the attention of value investors. Conclusion: we think the market likely needs more time to absorb the recent 30-month rally, which could produce lower prices. We don't foresee new all-time highs in Bitcoin for 2018, and unless data starts suggesting differently, we are expecting mostly sideways or lower price action.